All right, so now that we've gotten all that out of the way, we're going to begin. Audrey, I'm so glad to have you here, and we're super excited to have you telling us about common tax issues faced in the domestic violence context. And please go ahead.
Can you hear me okay?
Yep.
Okay, great. Let's see. I just need to play around with a moment, just having a slight little technical glitch here. All right, so hello everyone. I'm an attorney in the Federal Tax Clinic at Harvard Law School. We are a free legal services program located in Jamaica Plain, but our tax clinic accepts clients from around Massachusetts. For today, I am highlighting some of the common issues that low-income clients who are either in, leaving, or have already left domestic violence situations may face. In doing so, I will be discussing exclusively clients who have had either a spousal relationship and or share children with an abusive partner. The reason being that those are the situations in which tax problems are normally going to arise. Tax issues are tied closely to issues of economic justice for people in abusive relationships, either directly because the abusive partner is asserting control over a tax return or a tax refund, or indirectly where someone has been left in a complex financial mess as a result of trying to hold a family together in perhaps dangerous or dysfunctional circumstances in the home. And so tax is certainly a piece of the puzzle when someone is trying to put their lives back together. Excuse me, I apologize. I'm having trouble moving the slide forward. Let's see. Hello, can you still hear me?
Yes, we can still hear you.
Okay, so I'm sorry about that. My pointer disappeared for a moment. Okay, as a lawyer, I have to start out with a disclaimer. I've got a slideshow here to help guide my talk, but it is not meant to be a comprehensive guide. I don't recommend coming back later and checking out the slides when doing your own taxes or helping someone else, because there are exceptions to every rule that I'm going to talk about. And so I'm certainly not promoting that anyone use these slides as, the final word on the law. Rather, what I'm trying to do today is to help raise awareness about these issues so that people can properly refer clients to help. Let's see. Okay. Oops. Sorry about that. So knowing where to refer people is key. In tax, there are going to be two main types of services that people need. The first is going to be tax preparation, advice, and planning, which our clinic does not do. For that, you want to refer somebody to VITA Sites or an organization, the Boston Tax Coalition, and I have the information for those referral programs at the end of the presentation. I also, for what we do at the Legal Services Center, we're designated as a low-income taxpayer clinic by the federal government, so that we're helping people with cases and controversies before the IRS, particularly collection cases where people are unable to pay, and also situations where people are contesting liability or the denial of a deduction or a credit, such as the Earned Income Tax Credit. I am not going to cover the types of legal cases and controversies that we do in great detail. The important thing to know, though, is that if you're working with somebody who already is getting collection notices from the IRS or feels that they've been improperly denied a refund, you do want to talk to them about a referral to a low-income taxpayer clinic. I'm going to, again, give the link to all of the different ones in Massachusetts. And again, our own clinic can take people from across the state and help them with those issues free of charge. Right? So I think here is our first polling question. So do most of your clients who you see coming to you for help with their tax returns, are they coming with current year filing questions or past audit and collection questions?
Awesome. And so while people are answering this, Audrey, I'm actually going to switch to sharing the screen on my side. And
Okay.
you can just let me know when you want to switch slides. I can do that while we go through. Does that feel okay?
Yes, certainly. And I apologize for the technical difficulty.
No, you're totally good. It's hard to figure out sometimes. It's just zoomed in differently.
Okay.
Okay, awesome.
So once the results of the poll come in, we can move on to the next slide.
Awesome. All right, so I see that some folks have answered the questions. 2 people say current year, another person says even mix, and then another person says rarely discuss tax issues at all.
Okay.
Awesome.
It's good to know that both for referral purposes and when you are, giving people a flag about what kind of help they should seek. Current year filing of a tax return is a very different situation than when somebody has already been flagged by the IRS as having a problem with a prior return. The IRS can audit returns for up to 3 years, but they often go further than that if they see a substantial mistake or substantial problems. And so the sooner that person gets referred somewhere for perhaps legal advice, the better. All right, so here we have the main topics that I'm going to review today. Again, I try to, to choose things that have a direct impact on, again, people in family situations who are experiencing domestic violence or have experienced it in the past. This is certainly not comprehensive, but dependents, filing status, child tax credit, and earned income tax credit, and innocent and injured spouse are the most common issues that often are going to arise. On the next slide, we have another polling question. So we can move forward one, yeah. So what is the most common tax topic raised by your clients, if they raise any at all?
All right, so some answers are coming in right now. We have 1 for earned income tax credit, and then another one for none. Oh, and someone wrote claiming dependents.
Okay.
Awesome. Oh, and a filing status as well. All right.
So we can go on to the next slide, if that's fine. Okay. So we'll start with talking about who counts as a dependent. Dependence is a complex term because there are overlapping and different requirements depending on how dependents are used, whether as exemptions or for purposes of head of household status, for the earned income tax credit, or the child tax credit. The broadest use is for dependency exemptions, although as many of you probably have heard with the new tax bill, there's going to be changes to that. The dependency exemptions are actually suspended for the next 8 years. I'll mention that again in a little bit. However, it's still relevant to understand not only for this past tax year where people can still claim exemptions, but because of IRS audits of past returns where it may come up. Was somebody correctly claiming somebody as a dependent? A general rule for dependents is that you can't claim one if you yourself are a dependent. You can't claim a married person as a dependent. There is an exception to that if the married person was filing a joint return for a refund. And they must be citizens, resident aliens, nationals, or residents of Canada and Mexico. Resident aliens is not the same definition as you'll find in the immigration code. I can't really get into that detail with that right here, but Basically, it refers to people who either have a green card or have passed what's called the substantial presence test with a certain number of days in the past year in the United States and a certain number of days over the past 3 years. There are two main types of dependents, and the first type that I'm talking about here on this slide is the qualifying child dependent. So for someone to be a qualifying child, they have to be the taxpayers, their legal relationship is parent-child or grandchild or great-grandchild. The language of the code is actually a descendant. It can also be a sibling, a brother or a sister, a stepbrother, a stepsister, or a descendant of any of those categories. So nieces and nephews count as qualifying children. They have to have the same principal place of abode as the taxpayer for more than half the year. There are exceptions to this that I'll talk about later in the case of legally separated parents. The most recent definition of qualifying child has them at younger than 19 throughout the tax year, or if they're a full-time student, younger than 24, or someone who is permanently and totally disabled. Number 4 is where a lot of people get tripped up. It's where the dependent has not provided more than half of their own support during the tax year. That does not mean that the taxpayer who's claiming the dependent has to have provided half the support. It just means that the child, him or her or their self, shouldn't have been the one providing more than half their own support. So if they have a job, if they're 17 years old and they have a job and that job is full-time and that's how they're supporting themselves, they can't be a qualifying child. On the other hand, if they're getting half their support from elsewhere, such as Social Security, disability, that support is coming from the government, not from them. So they could still potentially be a qualifying child. And of course, as I mentioned earlier, they can't have filed a joint return with a spouse. The exception for that is to get a withholding refund. Of course, life is never so simple. Particularly tricky can be the residency test, the principal place of abode, and the rules for a person being a qualified child of only one taxpayer. 2 people can't claim qualifying children on the same qualifying child on 2 separate returns. For the residency test, for the principal place of abode, temporary absences during the tax year are okay. For reasons such as illness, school vacation, juvenile detention, or military service. So for example, if somebody's otherwise qualifying child is, if they've been sent to juvenile detention for a crime and they're living there for half the year, that doesn't change the principal place of abode analysis. If they otherwise would be living with that taxpayer. Again, only one person can claim a qualifying child unless it's on a joint return. And for the exemption, the child tax credit, and the earned income tax credit and head of household status. There is a complicated set of tiebreaker rules that I can't cover in depth right now, but one relevant one to note is that between 2 unmarried parents, it will go to the one with whom the child lived for more than half the year, or to the one with a higher AGI, higher adjusted gross income, if the child lived equally with both of the parents. And this happens often when people are in the same home, 2 unmarried parents, they're living under the same roof, they can't file a joint tax return. The one with the higher AGI is the one that's going to be able to claim the qualifying child. And again, a little later, I'll talk about the special rule for divorced or separated parents. We can go to the next slide, slide 8. Okay. So the second type of dependent is a qualifying relative. More people can count as qualifying relatives. Qualifying relatives can be used for exemption purposes, but not, and for head of household purposes, but not for the child tax credit or the earned income tax credit. So again, the list is pretty self-explanatory. 1 through 6 describe different types of relationships that count as qualifying relatives. For numbers 1 through 6, a child, and this would be a child that otherwise wouldn't count as a qualifying child. So You know, perhaps you have a 20-year-old child who doesn't work and is your dependent. They would be a qualifying relative, not a qualifying child because they're over 19. Brothers, sisters, stepbrothers, fathers, mothers, sons, daughters, or brothers, or that should be brothers-in-laws, son-in-laws, daughter-in-laws. All of these relationships are potential qualifying relatives, and they don't have to live with you to count for the dependency exemption. They would have to live with you if you're using them for head of household status, but not just for the exemption. An individual who is not your spouse that lives with you as their principal place of abode for the tax year and as a member of your household can count as a qualifying relative. But again, unlike the other relationships listed, that person would actually have to live with you. The second rule is that the person made less than $4,050. That was the, you know, that information is current as of 2017, I believe, but that number can change. It's really the number, it's really the amount of the exemption itself. If the person made more than that, they're not going to be able to be a qualifying relative dependent. One thing to highlight that's different between qualifying relatives and a qualifying child is that the taxpayer provided more than half the support. So if you remember, the rule for the qualifying child is that the child did not provide more than half of his or her own support. But if you're looking at somebody as a qualifying relative, then that person had to have had more than half of their support provided by the taxpayer. An example would be, let's say you're claiming your brother who is on SSI and living with you. You would have to show that you provided more than the amount of money that they received from the SSI, up to and plus $1. And again, somebody can't be both a qualifying child of the taxpayer and a qualifying relative. So we can, oh, and one last thing to note is that a spouse cannot be a qualifying relative. We can move on to slide number 9. Again, there are 5 different filing statuses. I'm really going to just talk about 3 right now because they're most relevant to our discussion. Again, in an abusive relationship, a single person with no children can absolutely be a victim, can absolutely have their finances ruined by an abusive partner. But if we're looking at this through a tax angle, it's not likely to impact directly on their tax return. If they're going to file a single tax return with no dependents, you know, they're really going to be doing that separately from the other person and on their own. Where it gets tricky is, again, especially with married partners, and also with ones where there's children involved and it's not clear who is going to get the tax benefits of those children. So the discussion I had just made about dependents, try and keep that in mind as I discuss their impact on filing status and on credits. Again, I'm cherry picking here, but we're going to talk here about the 3 that are usually going to be an issue for people. I believe we have another polling question on the next slide. So do people that you're working with usually prefer married filing separately to joint returns if they're married?
All right, so 3 folks voted unsure for this one.
All right, so we can move forward. Okay. All right. So just kind of full disclosure here, before I started working in tax law a number of years ago, I used to be a family law attorney focused on domestic violence. And, you know, I have a lot of personal experience being in courtrooms and sitting down and trying to figure out some of these issues in the context of people going through a divorce. And in the context of people going through divorce where I was often representing someone who had been who had experienced some severe abuse at the hands of their former spouse or soon-to-be former spouse. And it was in the course of that I really started to think about the importance for people between married filing separately and joint returns. From a purely practical or legal or financial point of view, a joint return is usually much better, right? It means there's going to be a higher deduction. For the standard deduction is actually going to be doubled. There's generally going to be a lower tax rate, larger refunds, and if there's children involved, there shouldn't be any controversy over who gets to claim the earned income tax credit, the child tax credit. But on the other hand, it requires the cooperation of both spouses. They both have to sign, they both have to agree to what's on the return, and when the refund comes back, they have to figure out how to equitably share it. And on the other side of it, if there's any liability, it's going to be joint and several liability. The IRS gets a joint return come in, and unless we're doing something like an innocent spouse or an injured spouse, which I'll talk about later, the default is that both people are fully responsible for any tax liability on the return. Married filing separately, of course, generally means that you can't, in the federal context, get the earned income tax credit or take education credits. You can get the child tax credit, but the income phase out is going to be significantly lower than it would be on a joint return. However, when we are talking again about clients in or in the process of leaving an abusive relationship, again, the feasibility of the joint return can come into question, and it can come at great risk. Where it works best is usually, if people are in the process of a divorce and each side has a lawyer and there's a judge to facilitate working out the last joint tax return that they're qualified for, that's great, and it usually can work smoothly, but it's on its own, it can be very terrifying for clients. And I have certainly, both in the family law and the tax law context, met clients that have a strong preference to just do married filing separately and forego the extra money or the extra credits that they otherwise would have. I'll mention this again later, but in Massachusetts, there's a new rule where married filing separately is not going to stop someone from getting the Massachusetts earned income tax credit. But again, most of what I'm talking about here in my presentation has to do with federal returns, and I'll come back to that point in a little bit. There's also an element too, for some clients, of a feeling of independence if they do married filing separately as opposed to a joint return. They just don't want to, again, it's not just that they may be afraid or distrust the other person. They may, simply on their own say, I want to handle this myself. The less that I can interact with the abusive partner, the better. And that's really a decision for a client to make. It's just important that they're fully aware of the consequences of doing married filing separately. Okay, I think we can move on to slide number 12. Okay, so head of household is a filing status that certainly is one that is often picked up as by the IRS for audits. It's easy to make a mistake with head of household. Again, the basic requirements are that somebody is maintaining a household where they pay for more than half of the household expenses. That includes things like mortgages, utilities, repair, maintenance. You have to be either unmarried or considered unmarried on the last day of the tax year for which you're claiming head of household. And you have to have either a qualifying relative or a qualifying child who lived with the taxpayer for half the year. Now, if you recall, when I was talking about qualifying relatives, for numbers 1 through 6, for those relationships, they don't have to live with you if you're only claiming their dependency exemption. However, if you're claiming them for purposes of head of household, they have to actually be part of your household for half the year. And that's exactly where people often make a mistake. They'll put down that they have a dependent, perhaps a sister-in-law who doesn't work, and that they're supporting, but if she doesn't live with the taxpayer, then you can't use that person for head of household. And the exception is dependent parents, so elderly parents that are living, let's say, in an apartment and you're paying for their apartment, they get to count as qualifying relatives without living with you, but that is really the only exception there. We can do the next slide. So unmarried seems pretty obvious, but like everything, it can be tricky. It's based on December 31st of the tax year at issue. It could just mean that you're not married, you were never married. It could mean that you've had a divorce that's been finalized, or that you're legally separate, where you actually have separated, where you have a family court order. Perhaps, you know, different states will deal with this differently. In Massachusetts, it might be a separate support order for married people who have not, you know, actually divorced, but there's an alimony or a child support payment involved, where they have, again, separate support and separate households. For divorces, the divorce would have to be complete. So an ongoing divorce from December into January does not mean the person was unmarried in the prior tax year. And it means that they actually still have the option of filing a joint return. Could we do the next slide, please? Considered unmarried, again, this gets particularly interesting. It's, you know, you could still be legally married and possibly count for head of households filing status. You'd have to not file a joint return, and you'd have to maintain a separate household. So if you're working with somebody who they left their abusive spouse, they haven't gotten a divorce yet, and they went to move in with their parents, they're not going to be able to do, they're probably not going to be able to do head of household. Again, there are some exceptions depending on the facts, but they'd have to be maintaining their own household. We have some ways to argue that there are such things as households within households. You know, if somebody is, let's say, in a large multi-room apartment and they have a child and they buy everything separately from the other people that live there, there are certainly ways to do that. It does not always mean that the physical space is only you and your dependent, but that becomes more and more difficult to prove the more somebody is meshed with somebody else's household. You're considered unmarried if you also lived apart from the spouse for the entire last 6 months of the tax year. So it's not 6 months within the year, it's the last 6 months. And in that time, you provided a dependent child, a stepchild, or a foster child with a home for more than half the tax year. I will note there is an exception with non-resident alien spouses. Again, when it comes to the intersection of immigration and tax, I often will tell clients to make sure they consult with their immigration attorneys. We're not experts on that here, but if somebody is here and their spouse is in a foreign country and is not obligated to pay taxes in the United States, is not moved here, and they're maintaining a completely separate household for tax purposes, they may be considered unmarried. All right, could we go to the next slide, please? And then finally, another benefit of the dependency, another place where dependence is often an issue is with the child tax credit. As of 17, as many of you know, the child tax credit can reduce the tax bill to up to $1,000 per child. And for the child tax credit, the child must be under 17, even though they only have to be under 19 for the qualifying child exemption. They have to also qualify as a qualifying child. So basically, all children for child tax credit purposes could be a qualifying child for the exemption, but not all qualifying children under the exemption could qualify you for the child tax credit. The child has to be a U.S. citizen, national, or resident, and must have lived with the taxpayer for more than half the year. Again, there is an exception here for separated or divorced parents. And then there is an income phase up. So after a certain amount of money, I believe it's $75,000, it's phased out. And that's on a single return. On a joint return, I believe it's $110,000. And then $55,000 for married filing separately. Could we go to the next slide, please? All right, so the earned income tax credit, this is what, is very, very important to a lot of people. It's the way the IRS itself describes it, it's that it's a benefit for working people who have low to moderate income. And as they say on their own website, a tax credit means more money in your pocket, and it reduces the amount of money that is owed. It is heavily audited. It is something that, Congress, for better or for worse, has always been leery of fraud when it comes to the earned income tax credit, either of people trying to increase or reduce their income so that they qualify for it, which is why by law, refunds for the EITC can't even get processed before mid-February in a given tax year. It's a common place where mistakes are made. Again, people will try and, claim people that, as qualifying relatives, for example, instead of a qualifying child for the earned income tax credit. If we go through the requirements here, only the income that's earned, such as wages, is going to count. Something that you inherit, something like Social Security income, investment proceeds, these are not earned income. So it isolates the money that's considered by the IRS to be earned. It is only for people that have a valid Social Security number. So, a temporary taxpayer ID number is not going to work for the earned income tax credit. And that has to be for the taxpayer, their spouse, if it's a joint return, and for whatever the qualifying child is, if a qualifying child is going to be part of it. There are investment caps and an income phase out. Again, people can consult the the IRS charts on how much money you can get. And it is only for the single, joint, head of household, a qualifying widower's filing status. So again, married filing separately in the federal side is not going to get someone an earned income tax credit. I have a note here how in Massachusetts, actually because of a lot of the lobbying work and push that was done by Jane Doe and a lot of other organizations, the Massachusetts version of the AITC does have a domestic violence exception for filing status. So you're no longer dependent on having to do that joint return if you can show that you, had been in an abusive relationship and you had to do, your own filing status. You don't need to have, someone doesn't need to have a dependent to qualify for the earned income tax credit, but it phases out very, very, very quickly if you don't have a dependent. So, for example, the 2016 numbers were such that if you made $14,000 in income or more and you had no dependents, you weren't going to qualify for the earned income tax credit. And whereas for a single person with one dependent, the phase out started at $39,650. So it makes a big difference whether or not somebody can claim a dependent. And it can also bring a lot of money back, especially if somebody is on the higher but not too high end of the income chart. For example, again, using 2016 numbers, a single person with two children and an income of $28,000 would get an earned income tax credit refund of $3,876, and that's around where it plateaued that year. So again, it is an extremely important benefit, particularly for low-income clients. The most common errors with it are, again, claiming a child who is not really a qualifying child, and married taxpayers filing incorrectly as single or incorrectly as head of household. And then over or under reporting income to maximize how much money they get back. All right, I think on slide 17 we have another poll.
Yes, and for time's sake, because we're at 1:40 right now,
Okay.
if folks can just come back to these polling questions and think about them, we'll actually skip the last two polling questions. Is that okay?
Yep, that's fine.
Awesome, thank you.
All right, so I think we're up at, okay. All right, if we circle back to a moment to what, again, we do here at the Legal Services Center when we talk about cases and controversies for clients, we see a lot of people who, again, have made some sort of error on their tax returns or have been unfairly attributed an error by the IRS. And it's important to know that the more documentation someone has, the better. In head of household, qualifying child, and earned income tax denial situations, it is really important that the client be able to document that they ran a household, supported their dependents, and had the necessary relationships. And this will come up both on the administrative side when we are dealing directly with the IRS and things like audit reconsideration requests, or if we're on the US tax court side, where we're going in to file a petition for somebody and say, hey, the IRS got this wrong. But the burden will be on the person to have the records, as many records as possible. So advising people to keep things like school enrollment records, medical records, driver's licenses for the people of their household, and saving things like utility bills and mortgage payments and repairs, even if they seem like small, these kinds of receipts matter in terms of building up evidence to show that somebody was really maintaining the household and really supporting the people that they claim as dependents. We can move on to the next one. Okay, just some other quick notes on the new tax reform bill that passed in December. Okay, they had called at the time the Tax Cuts and Jobs Act. Then there was a rule in Congress that they had to change it, so now the law is 24 words long. But the basic things that can impact our clients is, again, the doubling of the standard deduction. It does double the child tax credit to $2,000 per child. One thing that's not on the slide is, unfortunately, now it is only the child tax credit will only go for people that have social security numbers and social security numbers for the child, not ITINs, not temporary tax ID numbers. And it takes away the dependency exemptions going forward. It actually suspends them for the next 8 years, and we really don't know what's going to happen to that in the future. But again, talking about dependency exemptions matters because somebody who files taxes today could be audited in 3 years for their 2017 tax return or their 2016 tax return, and they're going to want to have an understanding of who counts as a dependent and, you know, how, in what ways that they supported that person. We can move on to the next one, which I think is a polling question, so we can skip it. Again, as a lawyer here, I try and always bear in mind when working with domestic violence survivors, especially low-income survivors, that there are particularly vulnerabilities where legal issues overlap for them a lot more than for other clients coming from other types of situations. I always try and remember that a single incident of domestic violence can immediately trigger up to 4 court cases for a person. They could have a family law case, a criminal case, a restraining order case, a case with DCF, all with different judges, all with different docket numbers, all with different standards. And that doesn't even count the peripheral issues like foreclosures, debt collections, and tax cases. So if there is a family law case, either in child custody or divorce, the client is able to get particularly confused because it seems so all-encompassing. Every issue in their life gets discussed in that family law case, including tax. Tax will intersect here directly because it impacts joint liabilities in divorce situations, and it impacts dependents in both divorce and unmarried custody actions. The thing to remember when speaking to somebody, when they're filling out their tax return and they're in this situation, is regardless of what a separation agreement may say about who can claim the kids, for example, or who's paying a past liability, no family court order or agreement binds the IRS or the Massachusetts Department of Revenue for that matter. The only parties that are bound by those family court agreements are the parties in the case. The mother and the father, the mother and the mother, the father and the father, the spouses, whoever the 2 people are in the family court case, those are the only ones that are bound by those agreements. It creates a cause of action between the 2 of them. So for example, if someone's divorce agreement says wife is going to pay off the 2015 tax liability and then wife does not do so, The IRS doesn't care. What has to happen is the other party in that case has to go back and sue her for contempt in the family court. It's very, very hard for a lot of clients to understand that. And again, it is very, very common to say that a non-custodial parent, if they're compliant with child support, can turn around and claim dependence. That is only true if, in addition to that, they sign what's called IRS Form 8832. And it's a specific form that will release the exemption to the other parent. And that matters for dependency exemptions, and it matters for the child tax credit. It cannot affect the earned income tax credit. So remember I said earlier there are special rules for divorced or separated parents. That special rule is the signing of Form 8832. But again, that is not going to affect the earned income tax credit, only the dependency exemptions and the child tax credit. I think we should go to the next slide. Okay. So I have about 5 or 6 minutes here to go over innocent and injured spouse. This is very different from talking about the prior issues that had to do with actually filling out and filing tax returns. This is for what happens when later on there is liability assessed by the IRS. I'm going to start out just by pointing out that the terms can be very confusing for people. Innocent spouse cases refer to situations where the other person had, the other spouse has perhaps done something wrong, lied, cheated on their tax return, and now the other spouse wants to be separated away from the liability. Injured spouse is not a direct reference to any kind of violence. It refers to situations where one spouse has brought a prior debt, usually a prior federal debt or back child support, into a marriage, and the new spouse doesn't want to be liable for it. Again, when dealing with a client who has experienced a lot of abuse, there sometimes is a feeling that these terms make them feel like they're entitled to injured or innocent spouse. But again, in the IRS context, it's going to be very, very specific to what happened with the tax return, not necessarily as an access to justice for overall abuse in the relationship. And it's very, very important that that people understand that, so that their expectations aren't raised higher than is appropriate. We could go to the next slide, please. So the first question is these forms of remedy only apply if there was a joint return? If there wasn't a joint return, it doesn't matter, because the person is only putting down their own financial information on the tax return. If it's a joint return, obviously it is the spouse's information and potentially the spouse's liability. But before even looking at innocent or injured spouse, we'd want to know if the joint return is even valid. If the other spouse forged the signature of the party seeking relief, that doesn't count. It's not a joint return. It's an invalid return. Likewise, if the person had an illegal, perhaps marriage situation, if they were married in 2 different states at the same time in a bigamy situation, then those joint returns aren't valid. And what matters a lot for our clients is return signed under duress. Did the other spouse force our client to sign? This is larger than just the traditional definitions of domestic violence. For example, domestic violence in Massachusetts very much contemplates physical violence. In the IRS context, duress can go beyond that. It can be things like threatening to not allow you to see your family again, or some other financial coercion to get you to sign. Duress is not strictly defined in the tax code. It's a matter of trying to present all of the factors and all of the circumstances that cause the other person to feel like they had to sign. And the real test is that this person wouldn't have signed the tax return but for the forcing from the other spouse. We could do the next slide, please. So there are 3 kinds of innocent spouse relief. And again, this is something that, one of the low-income taxpayer clinics could help somebody with. This is not something that we're advocating, that somebody fill out necessarily on their own. This is something to really send them to one of our clinics for, again, the one here at Harvard or one of the others around the state. But it can fall under these three categories where the innocent spouse just didn't know about the income that had been left off of a return. This happens in situations where the other spouse perhaps had a business or a sideline or was getting money that he, she, or they never explained to the innocent spouse, and the innocent spouse voluntarily signed the return without understanding what had been left off. The second type has to do with people that are separated. They don't live together, they're far away. Let's say they recently divorced, but they did the last tax return as joint. And it's arguing basically that, look, we weren't together, I don't know what was going on, just split the liability fairly between us. The third type is most important in a domestic violence situation. I call it the catch-all type. That's relief type B. It applies in special circumstances where the more specific circumstances of B or C are not available. We could go on to the next one. Next slide, please. And these are really going to be a weighing of the overall circumstances, the marital status, the economic hardship. Did this person have a reason to know? Were they forced? But hovering over all 7 of these listed factors is the idea of domestic violence, because if there was any type of physical force or threat of physical force or violence in the household, that becomes something that can really throw the case in favor of the person who's asserting innocent spouse, and can really help them win their case. Just quickly, the next slide. This is more detailed than is necessary right now, but it shows the different ways we can try and assert an innocent spouse defense if somebody comes to us. We can do it in the tax court, we can do it administratively directly with the IRS. Again, these are just different forms of relief. And the most common one on the last slide, oh, I'm sorry, if we go to this one, Form 8857, this is the way to try and do it administratively. An important thing to understand, though, for an innocent spouse is that the non-requesting spouse will be notified. That is just the way it is. There is nothing that can be done about that. You can't assert innocent spouse without the other party knowing. So, of course, any client who is afraid of the former spouse or the spouse, we'd have to really sit down and explain that to them. They'd have to understand that and do it, knowing that the other person is going to be notified. And just a final point too, information that people are sharing directly with the IRS in any of these types of cases is confidential. It's protected by disclosure laws, but information about somebody's household or immigration status or living situation that's presented in a U.S. tax court case is not going to be protected by disclosure laws. It's public. So these are always conversations that we always try and keep in mind when we're dealing with clients, to make sure that they don't unwillingly send out information that they didn't want kind of sent out into the world. I mean, these are decisions at the end of the day for the client to make. So again, just wrapping up, the last 2 slides have, I'll just say really quick again, injured spouse, administrative proceeding, there's a form to fill out. This is not where you're necessarily alleging wrongdoing, but it's for situations where you felt the other spouse brought a debt that is subject to a tax refund seizure into the marriage. And this is both for domestic violence and non-domestic violence situations. It's just something to bear in mind, to know what it is, because often people will switch the 2 terms. All right, and then tax preparation resources. Here I guess maybe we can send these out by email, but these are the lists of VITA sites for tax preparation. And then the last slide, shows the contact information for the low-income taxpayer clinics located in Massachusetts.
Awesome. Thank you so much, Audrey, for all of your help today and all this information. I just wanted to kind of go into Q&A if that's possible. We had a couple questions that folks put in the group chat. If anybody else also has any questions that they want to add, feel free to put them in the group chat as well. And just to let y'all know, we're also going to be sending out these slides after this webinar. So while we're doing Q&A though, I wanted to put up the survey. If folks can fill this out and give us feedback, that'd be really useful. We're always using surveys to be able to better our webinars and all of our trainings and meet memberships needs. So I launched the survey. And so Audrey, we had a quick question from Deanna asking specifically if about the claiming children. So if the other parent claims the same child and a person is claiming them as a dependent and their child separately, what happens?
So, you know, so if like 2 returns go in at the same time and each one claims the child, it's going to flag an IRS audit. Okay. And what's going to happen is when, like, for example, that's the type of case that needs to be referred to an attorney. And what we would be doing at that point, and if we got them early enough, or, you know, they'd have to be responding to the audit request information, and they'd want to put together the information showing that the, you know, I'm the parent that has custody of the child. I'm the parent where the child is living for more than half the tax year. If it's the reverse situation, again, and this would be for a divorce or where there was a child custody case for unmarried parents, and the other side was able to claim, they want to show that they had Form 8832 signed. So it's not that either party has to immediately concede, and they're not working against the other party directly. They're talking to the IRS, responding to the audit consideration. If they miss that, and then they're in the collections phase, we can do, again, what's called an audit reconsideration, or if they're within a certain timeline, we can take the case to tax court and say, regardless of what the other parent put on their return, this is the person who was qualified to claim the children that year. This is the person that had, you know, the right to do it. Awesome. And that's why, as I said earlier, keeping records is extremely important, especially records of address. I mean, sometimes we sit down with clients and have them fill out a calendar to show us exactly what nights of the year the child was with them.
Definitely. Thank you so much. We had another question that I think you touched on a little bit during your presentation, but since it was such a short presentation, could you go a little bit more into this? The question was, my client is undocumented, gets child support, and was told she cannot get a refund until she has a valid social security number. The client is unmarried, not working, has 4 children, and cannot qualify for child tax credit is what she was told.
Okay, that, and it's kind of, as I said before, we're careful to answer too many hypotheticals about immigration, undocumented immigration, so I don't want to mislead anyone. Is that a question that we could then send out like an email answer to the group?
Yeah, definitely. And so...
And I say that mainly because there were multiple steps in that hypothetical.
Yeah, so. Definitely. So So Audrey was really nice enough to offer her email for anybody who had any other specific questions and things like that. And we'll also be sending out materials and resources after this webinar. And so I'll connect you to that person who specifically asked that question so that you all can touch base and kind of figure out what the hypotheticals and steps are. Does that feel okay?
Absolutely, because what happens is, of course, the more steps in a scenario like that, the more possible exceptions, and especially in the immigration context, especially these days, I don't want to lead somebody astray.
Definitely. Thank you so much. So thank you all for participating in this webinar. If nobody has any other questions, then we'll be ending this webinar right on time at 2 p.m. If folks are joining us by phone, I'll be sending out this evaluation after the webinar as well, so you can answer our evaluation questions afterwards. Thank you so much, Audrey, for joining us and for offering your knowledge and also letting us know about the resources that are available at the Legal Services Center of Harvard Law School in Jamaica Plain. And yeah, thank you so much.
All right, thank you.
Bye-bye. Thank you.